U.S. inflation reaches a historical all-time high as the economy moves above 15% on wage price spiral. Welcome to Financify, the #1 place to get all your finance news stories and help you navigate this chaotic economy. Before we continue, be sure to hit that like button and subscribe to the channel. Now let's not waste any more time and get back to the video. At the end of the 1960s, the U.S. Federal Reserve and the Fed chair then McChesney Martin misjudged how hot they could run the U.S. labor market without fanning inflation. The miscue paved the way for inflation expectations getting out of control and a massive wage price spiral the following decade. The official U.S. CPI reached a peak at 11.8% in February 1975. It wasn't until the recession of 1980-82 and brutal policy rate increases to levels as high as 20% that inflation was finally killed. In 2022, the Federal Reserve and Fed Chair Jerome Powell repeats the same mistake all over again as the post-COVID outbreak economy and especially the labor market are severely supply-constrained, making a mockery of the Fed's traditional models. Powell believes millions of Americans will return to work and fill some of the 10.4 million open job positions as COVID-19 fades. But this is plain wrong. Some have retired early due to the crisis and thus have permanently left the U.S. workforce. The Federal Reserve Bank of St. Louis estimates the exodus of older workers to be about 3 million people. Others aren't returning to poorly paid jobs after seeing huge handouts during the pandemic and seem to be waiting for better jobs and pay. The big difference between today and yesterday is that the pandemic has fueled a great awakening of workers. Across sectors and income classes, they realize they are now more empowered than ever. They demand a better experience, better job conditions, higher wages, more flexibility, and a sense of purpose from work. Coupled with persistent inflationary pressures coming from the production side, the energy crisis and labor shortage, this results in unprecedented, broad-based, double-digit annualized wage increases by Q4. As a consequence, U.S. inflation reaches an annualized pace above 15% before the start of 2023 for the first time since WW2. This prompts the Federal Reserve into a too little, too late move to tighten monetary policy faster in a desperate effort to tame inflation. But the central bank has lost credibility. It will take time to regain it. Price inflation is at a 40-year high, 8.5% year-over-year, according to the March Consumer Price Index. Wages haven't quite been keeping pace. Average hourly earnings were up 5.6% over the same period, per the Labor Department's March jobs report. Federal Reserve Chair Jerome Powell has expressed concern about the wages part of that equation. He said the labor market is tight to an unhealthy level and that accelerating wage gains wouldn't be sustainable over too long of a period. What some economists worry about, and the Fed is trying to prevent, is the U.S. economy slipping into a wage price spiral. That happens when rising wages drive companies to raise prices, which in turn prompts workers to demand pay that keeps up with inflation, and so on. Once that cycle gets started, it can be hard to stop, as policymakers learned in the early 1980s. To try to better understand the connection between wages and prices in recent periods of high inflation, economic historian Thomas Stapleford of the University of Notre Dame suggested we look back in history, long before such high inflation moments as the aftermath of World War II, the American Revolution. 4,000 years ago, said Stapleford in the Code of Hammurabi, so ancient Babylon, they tried to set prices. For hiring animals, how much you would pay to hire a cart, pay for a surgeon's fees, pay for wheat or for grain. Stapleford said in the ancient period, wages and prices were treated the same in officials' efforts to control inflation. In our modern economy, wages and prices can get out of hand if there's a classic wage price spiral, as consumers are worried that prices are going to rise in the future. Stapleford explained, first of all, they're going to try to purchase things right now because they want to lock in something at price, the existing price, before it goes up. But they are also going to push for higher wages. That's what happened in the 1970s and early 1980s, when levels of high inflation comparable to what the U.S. economy has experienced for the past few months dragged on for the better part of a decade. From 1973 to 1975 and from 1978 to 1982, the CPI remained above 7.5%, peaking at 14.5% in March 1980. Columbia University economist and former Federal Reserve Gov. Frederick Miskinnen said the economy faces similar risks today. I think we are in a wage price spiral right now. If workers start to expect inflation to be higher, they have to ask for higher wages in order not to fall behind the 8-ball. It's great if you get a 5% wage increase, but if inflation is expected to be 8%, you can buy 3% less goods next year. So it's not doing a lot of good to have a high wage increase if in fact inflation is going up by more. Miskin argues that the Federal Reserve has failed to act quickly or decisively enough to keep prices and wages in check. When you're in a situation where the central bank loses credibility, people are not as convinced that they're going to control inflation, he said. That's exactly the time when workers and firms are going to end up with higher wages, and that's what we're seeing now. Some analysts, though, think we're not quite in a wage price spiral. I don't think we are necessarily entrenched in one yet, but I think the risk is very clear and very present, said investment strategy analyst Ross Mayfield at Baird, which is a marketplace underwriter. Mayfield said that what's driving inflation right now is principally the pandemic and the war, not workers' wage demands. Many people understand that this is both COVID-related and Ukraine-related. Long-term inflation expectations are still reasonable. They are not outside of the norm yet. There is also a camp among economists that views the risk of a wage price spiral driving inflation higher now or anytime soon as minimal. Economist Joe Bruselas at consulting firm RSM said workers simply don't have the clout to push wages higher and higher. He said that the tight labor market, driven principally by pandemic-induced labor shortages and demographic shifts, is the main cause of wage increases right now. This is not a wage price spiral linked exclusively to inflation in the way in which we saw during the 1970s, said Bruselas. At that time, labor unions represented approximately 1 in 4 American workers. Back when unions played a much larger role in the economy, many contracts were tied to inflation, Bruselas continued. In the late 70s, the United Mine workers were able to extract almost a 12% increase in pay in 1 year, linked specifically to inflation. Bruselas pointed out that while retirees on Social Security receive automatic annual cost of living adjustments, now very few workers do. He said companies have been able to pay higher prices for supplies and higher wages to attract workers without hurting their profit margins. To him, that's evidence the pressure to raise wages isn't hurting employers or the economy. Meanwhile, that pressure is helping lower-income workers whose wages have lagged for decades. What we're seeing is a resetting of wages, especially for lower-income cohorts, Bruselas said. The working class, the poor, and the lower strata of the U.S. middle class are seeing wages go up. Meanwhile, that pressure is helping lower-income workers whose wages have lagged for decades. What we're seeing is a resetting of wages, especially for lower-income cohorts, Bruselas said. The working class, the poor, and the lower strata of the U.S. middle class are seeing wages go up. Higher wages are a good thing in the American economy and not to be feared, Bruselas continued. We do not have a classic wage price spiral, and that can't be repeated often enough. I predict extreme volatility in U.S. equity and credit markets. The J&K high-yield ETF could fall as much as 20%, and the VIX mid-curve volatility ETF soar as much as 70%. By the fourth quarter of 2022, the wages for the lower half of U.S. incomes could rise at an annualized 15% clip as companies scramble to find willing and qualified workers who are increasingly selective due to a rising sense of entitlement as jobs are plentiful.